everyone. Welcome to another edition of the Grain Gauntlet. Back after 1 week hiatus. Not that we missed too much with the war going on and everything else, but things seem to be settling down a little bit this week. And of course, next week we've got the Planting Intentions Report. So with me, I have Hedge Plus owner Patrick Hayes. Are you ready to answer some questions?
I'm ready to rock.
All right, here we go. First question. How much will high urea prices affect corn prices?
I think very significantly, the longer that there is an issue, the more delay of us getting urea through the Straits of Hormuz, the less people have cheaper urea to put on their fields, and that means their input costs go up, which means maybe they plant something different. Maybe they use less overall fertilizer, although urea, which is nitrogen, has to be applied for the corn crop. There's no way to get around that. So higher costs for farmers mean they have to have higher prices to keep planting the stuff, or we just plant less. So I think this could be more important than the Ukrainian war for prices if it's prolonged at all.
Okay, yeah, I certainly see the financial markets and financial analysis have started to take notice. Goldman Sachs joined Bank of America in projecting higher food prices because of this issue right now. So it's definitely something that seems to be expected and somewhat built in at this point, regardless of whether or not the war ends soon.
Right. There's going to be some effect for sure this year.
Yep. Okay. Second question says, do you expect any surprises from the USDA with their planting intentions report?
Well, I didn't expect any surprises in January, and look what we got, a huge surprise that the whole market missed. So you never know with the USDA. If you're asking me what's likely to happen, I think the outlook was only a month ago, so they'll be pretty close to those numbers. If anything, they should take note of the war and the realization that fertilizer costs are up and maybe prepare the market for higher prices by cutting corn acres a little bit, increasing bean acres or sorghum acres or stuff like that a little bit more. So maybe a bullish report in a sense of less corn acres.
Okay. All right. So next question says, is the Iran war and a strong biodiesel mandate the combo that gets us $12 beans?
It would be helpful. How high and how much would be helpful? We'll see. We definitely need alternative energy. Biodiesel would be a great alternative and would raise demand for sure. How much demand is offset by higher prices is the question why I can't answer that right now, because we don't know that. The longer this war goes on, the more inflation there is, the more offset to demand there is. And so, yeah, we have potentially new demand. At the same time, we also have potential for people around the world not to spend as much as they have in the past on energy, on food, on wherever they can make ends meet by cutting, they will if we continue to have higher prices. So it's an offset thing. It'll favor higher prices in the beginning. Long term, it's not a good thing.
It's funny. What was absent in that question was any mention of anything having to do with China. So there's always that out there too. So there's definitely things that are out there that could happen to really pull us over that magic $12 number and maybe even beyond.
Yeah, here's the bottom line. China's part of the world, right? So if the world's demand starts to go down, so with China's, right? Their economy is probably more fragile than most in this case. If their people start using less because they're spending too much, it's going to affect overall demand. And so, again, it's a balancing act. China's a big player. They need to keep their economy strong. And right now it's a little wobbly.
Okay. Do you expect yields to be down this year due to high fertilizer costs and rationing?
No, I don't. I don't expect a big effect from fertilizer costs this year because most farmers put the fertilizer on when we had a good fall to do it last year. Will we cut back a little bit on fertilizer? Yes, we'll have some effect on yield. Maybe, but not as much of effect as El Nino will have, which is typically produces better than trendline yields. Having water or fertilizer, you need both, but having really good water supply for the year will keep the yield up.
Okay. All right. Final question. This one's from a prospect. Says, what single strategy or decision do you think will matter most for profitability as a corn and soybean grower this year?
The biggest decision they can make?
Yeah.
Make sure that every time the market sees a spike up, you have a sale made, and wherever you can hedge and protect with fixed risk to the top side is something that you absolutely need to do. Because in this kind of craziness, when you don't know what's going on, you should be doing something like we're doing with corn right now. We're hedging corn. We got the downside protected to add good value on a normal move down. However, if we continue to rally, we go to $7. We got fixed risk of anywhere from 2 to 6 cents right now for most guys. Having that kind of fixed risk allows you to be able to pick and choose better where to make cash sales, which is imperative. And if the market does collapse, you're going to add some value and you're going to beat your neighbors. And how unfortunate it is that you have to beat your neighbors to make money is the reality, because you all pay the same costs around you, right? And if you have more input money to pay that cost, you're going to win overall. So adding 30 or 40 cents to your bottom line with a hedge position that has fixed risk, I think is absolutely imperative this year. And to make sales when you get profitable prices, to make some sales and take some of the risk off the table. Those are two things that you can do besides growing a big crop, which you guys know how to do. I'm not going to even try to tell you how to do that because you're way better at it.
Yeah, great answer. There are definitely more opportunities already this year than there were seemingly all last year. I know in the moment when we have these rallies, sometimes people get gun shy and think it's just going to keep going higher. But even if it does, first of all, there are things you can do to capture that if it does, to act, to make sales at profitable levels, because the USDA is still not, projecting prices to be all that much better than last year. So to take advantage of these moments when they come is great advice.
One of the things that we have done, we made a sale for new crop around 480, right? And then we made another sale out a little bit, but the average price is somewhere around 490 on the futures. Okay. We left the hedges on for those positions. We didn't take them off because it's only 5 or 6 cents of risk that I'm risking and making on all the other crop with higher sales. So if the market does go down, those sales will net us 25, 30 cents at 430 or below. On top of that 490 average crop sale, I don't know anybody be whining about 520 a bushel. If they are, they're making money. If they have a good to better than normal crop, which El Nino usually produces, that gives you a great head start. So something with fixed risk in the account to go along with good sales that are profitable when we get that opportunity is a way to win this market this year.
All right, good. All right, well, thank you for your answers. Thank you, everyone, for your questions. If anyone has a question and they want to make sure it gets answered, go ahead and email it to adminstaff@hedge-plus.com. I hope everyone's just having a great week. We're looking forward to seeing what the USDA gives us on Tuesday, and we'll be back again with you guys next week.
Have a good week. Thank you.